what are the mindset changes that investors should remember to make when there is so much noise around you, when markets are down?
So money mindset is a lot of detachment to the money. The detachment to the money allows you to make money. Too much attachment to the money does not allow you to make the money. When Warren Buffett had come to India, the only time.
When was this? Which year?
This was, I think, about 7-8 years back. People asked him, what did you learn over the last 5 decades? He said, in 5 decades, you get 5 good opportunities to buy. And you have to use those 5 good opportunities. He said, what matters to you is what did you do in those 5 times in those 50 years mattered so much to your return.
One of your own mentors, James Monte, argues that the biggest mistake that investors make is their behavior and not actually market volatility.
Each person makes their own behavioral mistake. I'm capable of selling early. My colleagues, they have to just hold me. Some of the profits that I made in telecom stocks or power stocks, all are owed to my colleagues who held me back, saying you can't sell so cheap. You have to wait for it to double. You have to wait for it to triple. Even then, in a telecom stock, one of my colleagues has made much more money than me because he managed to hold it more than I could hold.
So when you get these calls wrong, how do you deal with that pressure?
See, the way investing is that you can't get all your decisions wrong. Then you won't have a job. The way it is you have to have more number of rights than wrongs. The day you decide that all your decisions have to be right, no, you'll never take any decision.
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to The Money Mindset. My guest today is none other than Sankaran Naren of ICICI Prudential AMC. Naren needs absolutely no introduction, but I'll give it anyway. He's somebody who has been a veteran in the mutual fund industry, someone who has been there for almost 3 decades now, manages almost 11 lakh crores worth of AUM at ICICI Prudential AMC. And today he's sitting here with me, not to talk so much about the here and the now, but to give you some timeless wisdom about the markets and perhaps how to approach the new year amidst all this volatility as well. Naren, thank you so much for being on The Money Mindset.
My pleasure to talk to all of you at Money Minds.
Last time we met was in Calcutta in September of 2024. And I'll not forget that you had at that point in time spoken about how this market is looking vulnerable and you should be cautious on mid caps and small caps. And that has played out. Where are we now as far as the cycle is concerned, according to you?
See, clearly the small cap euphoria is out. And I don't think there is euphoria in small cap. And many people who did direct investing in small cap, they've, I think, realized that you can't make money every month. You can't make money easily. I think that part of it is out. In mid cap, still there is a little bit of overvaluation, and that continues. So I think now we are in a much more comfortable position as far as small and mid cap is concerned. On the other hand, now you got these new age companies without earnings, without anything, which has become the darling of everybody. So that is a new euphoria. So, and you have euphoria and new things like silver. So, I think euphoria gets replaced. And the problem is for people like us managing other people's money, we don't know how long these euphorias last also.
True. Absolutely true. I think when we spoke last, there was a lot of caution in the system, not in the system, but caution from your end. But is it fair to assume now that maybe the worst of the fall that we've seen in small and mid caps is behind us? Or do you think that we could still be headed for some kind of a protracted bear market in mid and small caps?
See, I wish I knew the answers, but I think the reality is that what happens in US, how the US dominated financial system of the world, what does that mean for emerging markets is not clear to me. What is still clear is that US artificial intelligence oriented companies are still overvalued. And there is a valuation reset which will happen sometime in the next 3 years. So when that happens, do the emerging markets not focused on artificial intelligence like India, do they get an uplift? Do they fall with US? Do they fall less than US? That part of it we don't know. That part of it is not clear to me, and it depends on that. But if that were to fall along with US, even partially, then I think there is scope for corrections in the market, because it is not as if that the absolute valuations in any part of the Indian market is yet cheap, that you say ignore everything and buy. That kind of situation has not yet come. So it's tough to say. That's where we are at this point.
Okay, so you can't ignore everything and buy, at least at this point in time.
No, you can't. Because you don't know what will happen when, if there is a US led global correction, how much will India correct is something not known to us at this point of time.
India is in a very confusing space right now. On one hand, valuations are still not reasonable. And on the other hand, growth has not picked up as much as one would have expected to.
Yeah, but having said that, I think the government has done all that they can do to create growth, which is cut interest rates, cut direct taxes, cut indirect taxes. So they have done the three things that are there in their hand. And normally, when you do these three things with a lag, things improve. So I would say the outlook for 2026 from an India construct is certainly much better than the construct that we had in 2025. So from that point of view, India certainly looks much better on a relative point of view.
But you still won't go out and buy now.
No, I'm not saying you won't go and out and buy. I would say that the absolute valuations are not thumping the table. And absolute valuations do not signify at this point of time that you can put all your money in equity. It would still be that you have to do asset allocation. It doesn't signify that. Although the outlook for India is much better than what it was in 2024 December, I would say it's still not at valuations are not where it is that you can say put all your money in equity. That kind of situation doesn't yet come. So that's where we are.
So FIs have been avoiding India for a while now. I mean, it's been 1.5 years, and the sell-off continues. Why do you think that is? I mean, is it purely because of valuations, or is it the fact that we've missed out on the AI trade, or is there any other reason? And when do you see FIs coming back into the market?
Actually, we wish we had all these answers, but I think it is because of the fact that we don't have AI stories. I think that is what is the main reason. But when the AI stories, when AI ceases to be a story, will they immediately come to India, or will they come after the AI correction happens? That we don't know. That's why I think India is a good systematic investing story now. Because end of the day, whether India corrects during the AI correction, it's still systematic investing should work, asset allocation should work. I think both systematic investing and asset allocation should work, irrespective of what happens to absolute investing today. What happens to absolute investing today in equity is not clear to us at this point of time. But both asset allocation and systematic investing should both work. So both SIPs and asset allocation are not something we are worried about.
So what should the asset allocation be for 2026?
There is no one single
size
cut
fits all.
for each person. I would say certainly be more positive on equity compared to 1 year back. Be more negative on precious metals compared to 1 year back. These two are clear. Be more negative on US AI stocks compared to 1 year back. These are three things which are clear. And be less positive on global investing than 1 year back.
So you wouldn't chase negative on metals, you wouldn't chase the gold and silver rally anymore. You think that's done?
It's not that we know what will happen to gold and silver. Gold and silver are two products without price to earnings, price to book, and dividend yield and cash flows. So how do you value them? So frankly, what happens in the near term is very tough. But as a framework, we use things like gold to Nifty ratio, silver to Nifty ratio. These kind of ratios, if you use today, it's very tough to buy gold and silver today, because those are products where there is no earnings, there's no dividend yield, there's no cash flows.
But there's safety.
The safety is in the eyes of the beholder. So, so that's why I would say that these are stocks which are less safe than 1 year back. Although they are perceived as more safe today, I would say they are less safe than 1 year back, much less safe than 2 years back. And 2 years back, we were the people who are very positive on silver at that point of time. And, the entire multi asset framework, which we still believe in, is something which we believed in and actually recommended, because we felt that the Indian investor was actually only invested in gold as a jewelry, not gold as an investment. And when we popularized multi-asset investment, we actually popularized investing in gold and silver unintentionally at that point of time. And that was just the right time for investment in gold and
I
silver.
remember that actually. And multi-asset funds surprisingly have been the best performing category this year. It's up 15% year to date. I was looking at the data. Of course, it's because of the way gold and silver has performed. And I remember that conversation we had. So interesting. You're saying that the outlook for India is good, but it's not a screaming buy just yet. And you should be avoiding metals. You should be looking more into equities. I think that's how the law of the land is. My conversation today with you is more about timeless wisdom in the market and, the lessons that you've had in your 3-decade-long journey. And I'm very excited to learn more about that. But before that, you've studied market cycles for so many years now. From a layman's point of view, there is euphoria and there is fear. So the pendulum swings both ways. Which part of the pendulum are we at right now?
See, market cycles depends on asset classes. Like, for example, today, if you look at Euphoria is there in silver. If you look at Euphoria in USAI stocks, it was possibly peak Euphoria was 2 months back. Now, is it slowly sliding away? Possibly, but that is where I would say second area of Euphoria. Otherwise, in all the other things, you are at a place where things are, there's no euphoria. So where there's least euphoria always in is at this point of time in cash, debt, etc. Because no one is interested. No one is interested in investing in such things.
Mm.
So I would say that these are the areas. So at all points of time, you have to search for areas where there's euphoria and search for areas where there's anti-euphoria. But anti-euphoria, there were very interesting areas 1.5 years back. Like, for example, China that time, Brazil that time. Those were all very interesting areas of anti-euphoria at that point of time, rather fear. Today, you don't have fear in China, you don't have fear in Brazil. All those markets have boomed, actually.
Mm.
So I would still say euphoria is more in silver than to an extent in gold, and to a very large extent in USAI stocks and related themes.
So, when we talk about market cycles, when we talk about the way the market is shaped up for 2026 or just for the next couple of years, right? We just to wrap up this discussion, we also talk about themes and sectors. And I remember a couple of years ago, you were bullish on sectors that were not the darlings of the market, whether it's PSUs, whether it is a telecom, whether it's defense stocks, right? And then those sectors started booming and doing well. At this point in time, what would your thematic or your sectoral biases look like? Where do you think that there's least amount of traction or favoritism, and now maybe those sectors could start to pick up?
Actually, we missed defense. Of all the themes, one of the themes which we really missed, I would say, is defense. The others, what you mentioned, we certainly made very good money in. So, in something we are introspecting as a team, and I say Prudential, why did we miss defense? After the global war started, we should have built a bigger position in defense, like what happened between Ukraine and Russia. It's something that we are introspecting. But if you look at today, what has happened is everyone has taken risk after COVID. So what happens is once you have taken risk and you have invested in a set of stocks or sectors, sometimes people lose their patience. Then they start selling because of lack of returns. We have seen that's the most interesting theme which we have come up with, where people lose patience and you get the opportunity because you have long-term money of investors and you can buy out of the lack of patience of investors. So they invest in a sector or invest in a stock for 3 years. They wait for those returns. It doesn't come. They sell at the most inappropriate time. So we'll make money in the next 3 years.
Can you give me some examples?
It's happened in, like, for example, it happened in oil and gas, for example. So if you look at it, those stocks actually underperformed a lot. People gave up and sold the stocks to us. In select auto stocks, people about 6 months back, just before the GST cut, there were a lot of auto stocks which had underperformed. So, you got the opportunity to buy auto stocks. And you have to remember, we are managing public money at scale. So, we need to be able to buy scale, not small amounts. So our view is that in the next 3 to 5 years, we will get small caps cheap because people would have bought at wrong valuations, and they would have seen no returns for quite some time. Then at some point of time in the next 3 to 5 years, they'll come and sell small caps to us. So those will all be opportunities in the next 3 to 5 years. So we have to, unfortunately, investing is, there are two big problems with investing. One is investing is not arithmetic. I can do a conversation with you and tell you a lot of things. Some of what I tell you will go wrong. So even if I say, out of what I tell you today, something will go wrong, because investing is not arithmetic. The second is, the fact that investing is a zero sum game. In a way, what happens if I make money, it is normally, suppose I have bought a share cheap 1 year back out of another person. That person has actually sold cheap to me. So if Warren Buffett was the world's best investor, the counterparty to that person has lost money. So this is the second problem. So these are two things which people forget most of the time in investing. That investing is a zero sum game. Therefore, you have to be smarter than the counterparty at some point of time over a period of time. And that is needed. So that's why to buy in 2020 when the whole world was closed was a challenge, but it made you money and the seller lost money. And investing is not arithmetic. And people don't recognize that even the best investors will make mistakes.
Your style has always been contrarian, right? I mean, and that I'm sure is not easy to swim against the tide. Did you develop that over time, or did you cultivate it, or has it always come naturally to you?
No, it is based on the 90s experience. In 94, 95, was the first big bull market that I saw. And I realized that by being momentum, you actually get into trouble eventually. And we are not talking about earnings momentum. We are talking about price momentum here. And when 97, 98 happened, the momentum strategies had a complete problem, the price momentum strategies. So after 98, when we resolved what can work over the long term, what we realized was contrarianism works. And contrarianism with good research works the best. So in 2007-8, if you had bought infrastructure, I mean, you bought in 2010 junk infrastructure stocks, they would have gone to zero. You could have bought a lot of NBFCs in 2017-18 as they were falling. Some of them went to zero. So what happens is contrarianism with a calculator, which means that contrarianism with good research, that works the best. And that research has to be there. Otherwise, you will end up buying the wrong company and that wrong company will go to zero.
Yeah. So, contrarian investing, if you had to tell us a little more about it, because it's been your style for a while, what does it actually entail? You said, of course, the good research is a must, but to be a contrarian investor, what kind of behavioral traits does one need?
See, first is, no, you first think like, take a case like silver today. It's gone up 100%. So you shouldn't worry to sell silver today once it's gone up 100% in 1 year. It's the best performing asset class over the last 1 year, 3 year, 5 year, 10 year. So you shouldn't worry about selling. Similarly, if you're buying an asset class which has given no return for 10 to 12 years, you shouldn't worry. Asset class, not stock. So if you have the ability to buy an asset class which has delivered 5 years zero return, 10 years zero return, maybe which has gone down 10% CAGR for the last 5 years, given a return of minus 40% in the last 1 year as an asset class, not stock, then what happens is that makes you a contrarian. So because what happens is asset classes don't go to zero. In 2012, we actually launched a US fund. And at that point of time, people don't know 12-year return in US was zero. And people would have, it was such a tough task to convince people that US is a good performing market, can perform at that point of time. But 12 years zero return is an absolute phenomenal contrarian model. So if someone comes and tells you that 10 years zero return in an asset class, then that becomes a good starting point for contrarian investment.
So, if you go by that theory, the only problem with that is timing, right? Like, for example, mid and small cap stocks, they've been through now 1 year of a downtrend. But if you look at it, that would be a contrarian style of investing to buy into them now. But then, how do you know that they may not be in a downtrend for the next 3, 4, 5 years?
That's why, as I said, we had models like 1 year minus 40%, 2 year minus 15% CAGR, 3 year minus 8% CAGR, 5 year zero return. So if you looked at it, 2007-8 was when small caps peaked. Then the next small cap rally started in 2013-14. But if you had looked at in 2013 August and looked at some 6, 7 year return, it would have been zero. So you can't take 1 year and say it has become contrarian. You have to look at 5, 6 years. In 2024, I think the 24-year return on Hang Seng had become zero, the Chinese, the Hong Kong index. Those kind of things become very interesting. If by chance someone comes and tells you 20-year index return of a market is zero, then it becomes even more interesting. You can't predict the bottom correctly. You can't predict the top correctly. But the margin of safety which comes out of a 24-year zero return is really good. At some point of time, it had happened in 2024.
So then coming back to that point on silver, I mean, of course, there's a lot of euphoria about silver now, but who is to say that silver is not in a 10, 12-year bull market? And
No one can say. That's why no one can time the top. That's one of the basic principle is you do switching. You move out of a euphoric asset class and move to a fearful asset class if you find one. And that works much, much better than deciding that this is the top.
so what do you think is a fearful asset class right now?
Right now, there are no easy fearful asset classes. 2024, there were plenty. Today, there aren't, actually. But the reality is that if you, and you know, once it is asset classes and not stocks, you don't need so much knowledge. You know, in 2020, if you looked at it, anywhere in India, 7 year real estate returns were zero. 2013 to 20, real estate returns were zero in almost all parts of India. When you had 7 years zero return in real estate, it was something at that point of time which is attractive. It was not 10 years, but 7, 8 years was zero. So somewhere what happens, people think, that's why I said investing is not arithmetic. If people think you can get exact bottom right, exact top right, I don't think it's just possible.
And that's why mutual funds are doing so well, because people don't have the time, bandwidth, energy, skill set to pick stocks individually.
That is why what we tell people, do asset allocation and keep doing asset allocation on a continuous basis. That is the best way to build wealth for the long term, because that is the easiest and best way to build wealth for the long term.
So, a lot of us, I mean, all of us who are in this market have in some way have a confirmation bias. I mean, we choose to believe that India is doing very well. We choose to believe that the growth path is intact, which it has been so far. But there are a lot of, red flags as well right now. If you look at the AI trade we spoke about, that India is lacking, the job situation is not that great, the trade deficit numbers, the rupees at an all-time low. So there are several factors that are also kind of like worrying investors a bit, the lack of FI participation. From your view, how should one read into all of these macroeconomic trends as a retail investor?
As a macroeconomic trend, you have to decide what to look at. If FIs being in India is the positive, that's not necessarily the case. In 2008, FIs were not there in India. They started selling in 2008-9. That was the best time to buy. In 2013, they were selling at the time of taper tantrum. That was the time to buy. In 2020, they were not buying. Again, it was a time to buy. So people use wrong sometimes. If FIs are very, very big buyers, that is actually a more dangerous time in the market. from a contrarian point of view. If FIs are not buying like today, you can do asset allocation. If both FIs and domestic institutions were buying very, very aggressively, that is actually a risky time for the market. Today is a much safer time in the market because FIs have been selling. So, frankly, if you look at it, you can always in any market find some positives, some negatives. So, the way we look at it, India macro has been fantastic over the last decade. The only issues have been valuations. If you look at something like trailing PE or market cap to GDP, those kind of things have been high. So, on the macro side, things have been fantastic. They have never been better, actually. India must be one of the few countries in the world where the GSEC yield, the government borrowing rates, have come down in the last 5 years. In most of the countries in the world, the government borrowing rates have gone up because the fiscal deficit has been in control. So I don't think macro is a problem. Valuation has been a problem, not macro.
So there is no real concern as far as the Indian macros are concerned. So you believe that earnings will continue to pick up because we've seen some signs of earnings
No,
picking
no.
up
I
now.
think earnings will definitely pick up. The benefit of lower interest rates, the direct tax stimulus, and the indirect tax stimulus should all help in 2026. But the starting point for valuations is not cheap. That is the only problem.
But it's good to hear that you are much more optimistic now than you were a year and a half ago. So
Yeah. Except on the valuation front, we are clearly more optimistic because India has become contra. You go and look at 2025, you'll find India is the worst performing market in the world. And there was nothing macro which went wrong in India. Despite that, India has been the worst performing market in the world. So, obviously, from a contrarian point of view, you can clearly see, barring valuation, things are much better in India than they were 1 year back. And valuations are also better, but valuations were really high last year. They're still not cheap. That is the problem.
so you don't think that there could be some more time in which India continues to be the worst performing? I mean, you can't time it,
I
of course,
don't
but
think so. I don't think so. I don't think India can be the market which underperforms in 2026. What absolute return market will give in 2026, I don't have an answer. But I don't think 2026 India is going to underperform the way it has underperformed in 2025. I don't think so.
That's a very high conviction call, I must say. Similar to what you had said a year and a half ago about mid and small caps. At that time, I remember everyone was, like there were so many naysayers, and but you still stuck your neck out and you said that.
Because investing is about taking calls. If you're managing public money also, you have to take calls. If you don't take calls, you can't create alpha. You have to take calls to create alpha and hope they go right.
All you can do is hope. That's true. You have so many mentors or investing legends that you always talk about, whether it's Peter Lynch, Howard Marks, Michael Mobussin, etc. I want to understand from you what has been your biggest learnings from all of them. I mean, each investing legend has a different style, a different way, a different skill set. So if you can just take us through what your biggest learnings have been from them.
I think the most important has been from Howard Marks, that you have to have that's the whole concept of a cycle. Possibly I knew it, but I didn't know how to express it. So if you understand cycles in asset prices and in asset classes, you're in a very good position to make money for the long term when you're managing other people's money. So in 2020, the best quality companies were trading at very high valuation. It is not that the companies were bad. The companies were very good, but they were trading at ridiculous valuation. So you had to avoid them. So the concept of cycle in the India's best companies played out from 2020 to 25. So, similarly, today, there's nothing wrong with artificial intelligence. Artificial intelligence is going to change the world in the next decade. But the call that we have at this point of time is that the stocks in artificial intelligence are overvalued and they will correct. But it is not that artificial intelligence is not going to change the world in the next decade. I think it will change the way we do things. Definitely. Just like mobile phone change the way we live, I think artificial intelligence will change. So these are the whole concept of cycles. So, for example, what I find very difficult in investors is people take financial investment decisions without creating a framework. So, if they were to trade in derivatives, if they were to trade in equity markets, if they didn't follow a process, like I tell people, take a notebook for every financial investment decision you do, write something before you take the decision. Suppose you were to buy stock of X stock, 1,000 shares. You write out why you're buying it. Put it in a notebook and store that notebook every year between Christmas and New Year. Read that notebook and see what did you do with that notebook, so that that improves the quality of the decision. But if you take investment decision just because somebody called you on the phone and said buy share X, then at the end of the year you won't know what you have done. But if you have created a notebook, which means that I'm sure when you buy a car, you ask whether other people who have the car, whether that car is good. So similarly, for this notebook, you create for every financial transaction that you do personally, write out why you're doing it, and maintain that notebook, and set aside the period from December 25th to Jan 1st every year to review what you did that year. It will be a very simple way to understand whether you're focused on whether the whole process worked for you, whether you should listen to Anchor A, Anchor B, look at this channel, what should you do? And that will definitely improve the quality of your financial decisions.
But that ability to cut out all the noise and listen to your inner voices is something that, not just in the markets, but it's hard to do in general in life as well.
Then you're not interested in making money for in the long run for as an investor, which is very important. So if you are in this game, if you are trying to do something like gaming through investing, then so be it. But that is not the goal of investing. The goal of investing should be to improve one's net worth over a long period of time for the sake of you and your family. So I suppose that is the goal, and not not playing a game through
No,
investing.
absolutely. And I think when you're in your 20s, or, when you're at the early stage of your life, you tend to make a lot of these mistakes and learn from them and then move on. So I guess we all go through that journey. So you said Howard Marks, taught you about market cycles, or you learned about market cycles through his books, etc. But how does one study market cycles? If you had to give us an example of this current situation, right? How do you understand? Because it's very hard to time, it's very hard to understand peaks and troughs. So what would your analysis be about the cycle that we are in right now?
So a simple thing is, any asset class which delivers 100% in a year, stay away from it. Any asset class which delivers minus 40% in a year, start nibbling in it. Are you capable of doing that? That is contrarianism. But that is a start. So what would have been? That would have meant that in 2008, after Lemon, you would have automatically invested. Automatically, when COVID hit you, you would have put money in equity. So what happens is, you would have got invested both in 2008 after Lemon and in 2020. So the fact is that you have to create some checklist which forces you to invest at the right time in the market. And clearly in 2007, when 1 year returns on many equity funds went up so much, you would have automatically taken out money. When 1 year return goes up above a certain level, you say, I'll take out money. Then you would have taken out. The reason for the small cap or mid cap was, at that point of time, if you looked at small cap return from 2020 to 24, it was so high. And it was not small. It was possibly one of the best periods of small cap returns from 2020 to 24. And so that's why, if you looked at that 4 year return, it must have been stupendous at that point of time. So when returns become stupendous, the ability to book profits is one of the toughest things. Now, people say stay invested forever.
That was my next
So the
question.
stay invested forever is a model that you can do. But then in my investing career, and I've been in broking for 10 years and 21 years in mutual fund, I've seen that once you have a flat period for 5 years or a negative period, people want to take out money at that point of time. How many investors are there who invested in 2008 and 2006? Most of the people invested in 2006 and 2007, stopped investing in 2008. That is the problem. So that's why I'm saying that if you know what you are doing, and your past shows that in big market corrections you double up, then things are fine. But many investors don't do it.
So, young investors who are starting off now, who've not seen a big bear market, this buying and staying invested, is it something that will work for them?
It'll definitely work for them. Starting SIPs today will work for them. Definitely starting SIPs today will work for them. Starting SIP today in a silver ETF will not work for them. The challenge is you have to start in an asset class which has not delivered glorious returns in the last 2 years. So doesn't mean that silver will not go up in the next 1 year or 2 year. It may go up, but you have to choose an asset class without euphoria to start an SIP. The day you start SIP in euphoric asset classes, that means actually you're caught up with this whole euphoria.
Mm.
That is the challenge. That's why making money in the long run is very easy. But you should know how to manage your temperament in big bull markets and big bear markets. And you can't control when they come. That is not known. You know, when Warren Buffett had come to India, the only time, so we got a chance to meet as a group of some 400, 500 people in Delhi.
When was this? Which year?
This was, I think, about 8 years back, I think. So people asked him, what did you learn over the last 5 decades? He said, in 5 decades, you get 5 good opportunities to buy. And you have to use those 5 good opportunities. So if you look at the last 37 years I've been in markets, there was an opportunity around 2001-2 to buy very big. There was an opportunity after Lehman to buy very big. There was an opportunity after COVID to buy very big. Now, if you used it, you made very good money. He said, what matters to you is what did you do in those 5 times in those 50 years mattered so much to your return. He said that he did beautifully in those 5 opportunities which came up, and he used those opportunities significantly. No, the problem with that is why over a period of time, over the last 2 years, ever since people thought equities is a market which is too easy to make money, I have been telling people, don't go whole time into this business, do something else. Because the moment you go full time into this business, you want to invest every day something, you want to do everything every day. Then it doesn't make. Warren Buffett says in 50 years, there are only 5 years where you have to invest big. So then why should you be full time in investing? So you have to be full time in investing. Then what happens? Then you invest in all periods of time. Then you end up disinvesting in the long period of time.
Mm-hmm.
Whereas if you are going to invest only 5 times in a big way in 50 years and you'll make more money out of it, you don't need to be full time in investing. You can be a surgeon, you can be a teacher in a college, you can be a credit analyst somewhere, you can do something else in your lifetime, but don't be a full time investor. Full time investors can't take too many decisions every day.
And they can't take too many risks. They get very emotional about
They
it.
get very emotional.
Yeah, true. That's actually very helpful learning from Warren Buffett. I didn't even know that he had come to India. I don't know. Did you get a chance to meet him?
No, as a group of 400, we
group,
heard
okay.
him. That itself was great. This
Yeah.
this itself was beautiful. After that, in every such event, we've been trying to tell people, don't think that being full-time investor means more money. Because once you're not a full-time investor, you have more time to actually make money.
And
See,
invest.
as a CIO, I'm involved in so many things in my company. So what happens is, if I buy a power stock in 2018 or a telecom stock in 2018, I'm able to wait till 2022 for return. The moment you're a full-time investor doing only that, whether you'll wait for 4 years for that return, I don't know. But we have got so many things to do. So that's why we have patience. Once you have patience, you make money.
Since you spoke about stocks, you of course helped us understand how to look at market cycles as far as asset classes are concerned. But what do you do when you buy a good company, a good stock, great business, great parentage, no red flags, no corporate governance issues, but in a market fall, the stock falls at 20, 30, 40%, but business is intact. What do you do at that point in time?
You have to buy more, but you could have paid an excess valuation the first time you bought it. Suppose you bought something at 70p, it falls 20%, it becomes 50p. Then you're still maybe paying too much. So you just because it's a great company doesn't mean it's a great stock. There is a difference between a great company and a great stock. There's a difference between a bad company and a bad stock. Sometimes you can make money in bad companies also. Just because they are bad, they may be available very cheap, and another good company may take that company over. So there is nothing like good company means good stock. I mean, there are companies like, right now, quality companies. There are some quality companies, 2020 onwards, 2020, September, October to now, they have delivered almost no return. They have underperformed fixed deposits.
So what do you do at a time like that?
No, no, investing is not meant to be
Yeah,
easy.
yeah.
So there are times when you overpay for investing. If you overpay, then you have to be prepared to take pain. And you will realize it later. You will not realize it on that day. Whether you have overpaid or underpaid, you will come to know later. And many people today overpay for a lot of investments. So whereas going back to 2001, 2 and all, there used to be stocks available at 2, 3 PE also. Today it's so difficult because there are so many investors in India. So it's very tough to find undervalued stocks.
Okay, I want to also talk about the behavioral mistakes that people make in investing because, one of your own mentors, James Monte, argues that the biggest mistake that investors make is their behavior and not actually market volatility. As an investor myself, I've made a lot of behavioral mistakes, like sold during COVID or sold during Lehman, or not bought at the time when the market was at a trough. So, according to you, what are the big behavioral mistakes that one should avoid?
Each person makes their own behavioral mistake. I'm capable of selling early. So what happens is, normally in every fund, I have a co-fund manager. The co-fund manager actually has to hold me back to ensure that I don't sell early. So that is the kind of mistake that I make. There are other people who can't buy on a big market fall. Whereas for me to buy on a big market fall is very easy. So for them, they just freeze. So for me to buy on a big market fall is one of the easiest decisions on earth. So I have to go to them and say, buy today. It's fallen like this. The same company is available much cheaper. Buy today. So that's very easy for me. For others, it is very tough.
But why do you think that is? Why is it easier for you and tougher for them?
That I don't have an answer. But the other also, no, I'll sell off early. And my colleagues, you have to just hold me. Some of the profits that I made in telecom stocks or power stocks, all are owed to my colleagues who held me back, saying you can't sell so cheap. You have to wait for it to double. You have to wait for it to triple. Even then, in a telecom stock, one of my colleagues has made much more money than me because he managed to hold it more than I could hold. So each of us will keep making behavioral mistakes. It is impossible to avoid behavioral mistakes. The level to which you make behavioral mistake differs from person to person. Are you making too much or too little, or only some amount? You'll know. But the basic point is you have to keep introspecting, and then you have to come to a framework. What can help you to improve? So I have many of my colleagues who help me to reduce my behavioral mistakes. I help my colleagues to reduce their behavioral mistakes. So each of us work to reducing each other's behavioral mistakes. So that is what we do at ICICI Prudential, considering we manage public money. Now, how does an individual do it? I don't have an answer. But as an individual, what happens? Sometimes what happens, you actually, if two of you together can take a decision, it'll be much better because one person's behavioral mistakes may be another, not the other person. So maybe that's it. But if you make it a investment committee, sometimes Michael Mobussin says big investment committees fail because instead of behavioral mistake of mine getting offset by the other person, says all the behavioral mistakes get added.
And then there's confusion.
And then there's confusion. That's what he says. So he says optimal group to take a investment decision is three, he says, in one of his write-ups. He says if you create a very big committee to take investment decisions, they fail. Instead of one person's behavioral mistake getting offset by another, he says everyone's behavioral mistake gets added. That's what he has written in one of his pieces.
So, as you said, right, selling early is one of your behavioral mistakes. But when do you sell? Like, that's even a problem that I face. You pick a great stock, it does very well, and then you feel like, okay, it's going to do better. And then there's a market drawdown that comes in, then the stock falls 20-30%, then it rises again. So when to sell is a confusion that a lot of people have.
So it is switching. We have moved to a model called switching. So you sell because you find something better. So it is always switching. So sometimes as an individual, you can sell, you can switch to buy a house. You can switch to buy gold. You can switch to do something else. You can switch out of gold and silver to buy a house. You can do different things. You can switch to fund education. So you remove this word called sell and move to a word called switch. And this is what I've been telling people. The day you use the word sell, you get into behavioral problems. The day you move to a word called switch, you will have comfort. You evaluate two opportunities. You say, today I sell silver and buy this stock. I evaluate this decision between selling this silver and buying this mutual fund. That is an easier decision to do. Evaluate the switch decision. Can I move out of silver and move to this hybrid mutual fund? If you're able to write out the logic for it, do that. Don't think about this. Don't think about the sell decision. Think about the switch decision.
So have you recently made any such decisions, switching out of one asset class into another? And how have you taken that decision? I mean, I'm sure you do it on a regular
Individually,
basis.
I mean, if you look at our multi-asset fund, it has the lowest amount possible today in gold and silver. And we have moved that money to equity, if you look at our published portfolio. So we have done that. But has it worked in the recent past? We got it wrong. So that is the
The
situation.
timing of it is wrong.
Yeah.
Okay. But you feel at some point it will
it
work
should.
out. Yeah.
So it is a switch from silver to equity, effectively.
So when you get these calls wrong, I mean, of course, when you get calls right, it's a whatever, an ego boost, etc. Everything is good. But when you get calls wrong, how do you deal with that pressure?
Part of the job. I think when you keep doing it, see, the way investing is that you can't get all your decisions wrong. Then you won't have a job. So you have to get, the way it is you have to have more number of rights than wrongs. The day you decide that all your decisions have to be right, no, you will never take any decision. So, and sometimes no decision is a decision. Suppose you evaluate a stock and don't buy it, that is also a decision. So that is the way it is. So I would say that it is tough to avoid mistakes. The number of right decisions have to be higher than the number of wrong decisions. It is never that you can avoid wrong decisions. And no decision is a decision. If you didn't buy a stock, that is also a decision. If you didn't sell a stock, that is also a decision. This people don't understand very clearly.
Can you explain?
Suppose you had 100 shares of A. That share is, let's say, trading at 2,000 rupees. Now, today you evaluated and didn't sell. Then that's a decision. That you didn't sell is a decision, because tomorrow that 2,000 rupee share can go to 1,800, it can go to 2,200. So you have actually avoided a decision by not, you have taken a decision by not selling. People don't think of it that way. They think that there's no decision. There's a decision by not selling also, it's a decision. Today, if there's an IPO which comes and I have cash in my fund, if I don't invest in that fund, I'm in that IPO, I have taken a decision not to invest. So that is also a decision. Decision not to invest is also a decision.
Actually, I was speaking to a CEO once who told me that decision making is the biggest skill that should be taught in schools, or you should teach your children, because that is something that we are never taught. And then we have to suddenly one fine day take all the decisions in our life. But for you personally, because you have to take so many decisions, is it something that you cultivated, or was it a part of your childhood where you were given the, responsibility to take certain decisions?
So as I keep telling, my father gave me his entire portfolio once I started working and said, do whatever you want. You seem to understand stock markets. So then
He had a big portfolio?
with his money, very small portfolio. With a small portfolio, he gave me the chance to invest, disinvest, and he didn't
Experiment.
bother. He only knew his son, he thought his son knew stock market. So, and he gave me that freedom. So with that, I learned. And then you keep learning. Investing is about making mistakes, introspecting, Making mistakes, introspecting. Even today, it is not that at managing 11 lakh crores, we can say we will never make any mistake. It doesn't happen that way. So we will make, but it is about making mistakes, introspecting, making mistakes, introspecting, and doing better than peers. Finally, otherwise you won't have a job.
That is a whole discussion on another level, because that puts a separate level of pressure because there's so much noise around. One fund manager told me I never look at other fund managers' performances because then I just lose track of my thought. So I never compare. I said, how is it possible? Don't you, wake up in the morning and look at other fund managers? He's like, no, I don't do it, because then if I do it, then I lose track of my thoughts. But coming back, this is interesting. So your father gave you his entire portfolio, whatever was the amount, and said, do what you want with it, but there were no repercussions of if you lose money.
He didn't bother.
I think that is what maybe gave you the extra sort of, I don't know, freedom to choose and buy and sell whatever stocks you want
Absolutely.
without any repercussions.
Absolutely.
That's a big learning, actually.
Yeah,
As
yeah.
a parent also, I struggle to, teach decision making to my son, because as a child, every decision has a repercussion. So you'd rather not take that decision only and not deal with that repercussion than, the other way around. But anything else from your childhood that helped you cultivate this mindset where, you're not bothered about the noise, you're very focused, because contrarian investing is really, it's tough. It's not that easy.
No, you finally need to create a group of people who also feel comfortable with the framework that you have. And that over a period of time, we have in our company people, and I have my colleagues in the entire company, starting with sales. So if you give a call saying that mid cap and small cap is overvalued, don't think that I'm the only person being talked about.
Responsible.
Every salesperson is also questioned by his distributor. So it is a organizational DNA that we are going to do everything. uh, we are going to take calls, but we are not taking these calls just like a joke. We take it in the interest of the investor. We can go right, we can go wrong, but we will always try to do it. So that is the way it works. So becomes an organizational DNA that we try to do what is possible and hope everything works. And as I said, some will go wrong.
True, true. Coming back to learnings from, the legendary investors, we spoke about Howard Marks, Michael Mobussin as well. I want to understand from you a little more about his style of investing and what your biggest learning has been from him.
So we always do pre-mortems. So we have done historically pre-mortems. I think the best pre-mortem we did was when we launched Value Series 1.
What is a pre-mortem? I mean, for people who don't
Pre-mortem
know.
is simple, that you assume there is going to be an election. So you take you say, post-mortem is that something goes wrong. Then you say who's responsible for this error. That is post-mortem, as you know. Pre-mortem is you say, okay, there's going to be an election, or there is going to be an RBI policy. Now, what are the possible things which can come out of this RBI policy? Now, what do we take? Do you think in RBI policy a rate cut will happen? Will it not happen? So you do a pre-mortem and say, okay, RBI will not cut rate. And then we take a decision on that basis. Or RBI will cut rate and we'll take this decision. So that is what we call a pre-mortem meeting.
But how do you know the outcome is binary,
No,
right?
that's why it's binary. So we take a call based on probabilities. So you keep on taking, like, for example, in 2013, we realized that the upside on the market after a 5-year no return was so high that we said that we have to launch closed-end funds now, because that gives you the opportunity to invest for 3 years. So imagine for 5 years, there were no return from 2008 to 13. If there were 3 years more no return, it would have been 8 years of no return, which rarely happens in a growth country like India. So we took a call that after 5 years, we should launch a closed-end fund and try to collect money. That was almost the bottom of the market in August 2013. It was way back. That happened out of a pre-mortem discussion that we had in our company, that where we had a discussion where we said, like, what happens if what will happen? 8 years, zero return is very unlikely. So let's take this call of launching money through a closed-ended fund.
Okay. Any other examples of pre-mortems that you've done recently and where you've learned from?
I mean, every time any Fed meeting happens, we take a decision. Every time there is a big US presidential election, we have done a pre-mortem. But some of these calls, even if, for example, we will try to do it for every budget, we'll do a pre-mortem. So, because your post-mortem, what happens is that you always try to find out who has gone right, who has gone wrong. This is a decision we say, okay, probabilistically, this is what is going to happen. So then after that, this debate is probabilistically you can go wrong, but at least you have had a proper discussion before the event.
You've thought it through.
You
Thought
thought it
through the
through.
entire thing.
So we have had probabilistic discussions on something like Indo US trade treaty, which have not happened, but we have had this. Again, we'll have every 10 days we have a premortem on the trade treaty.
Okay. I would love to be a fly on the wall in that discussion because no one knows where that's going to go. What has your understanding been of
I
that?
don't know anything.
No.
I'm sure it'll happen, but I know nothing more than you would know.
But there is, as an investor, there is no reason to bank on that and, plan according to, because everyone says that once the US trade deal comes through, then the markets will fly. Once the
But
US, that's
that is
speculation.
one of the reasons why I'm quite optimistic that at some point of time the trade treaty will come and that will help FI flows also.
Hmm. Interesting. Okay, from Michael Mobussin, you learned pre-mortems. What else?
That was the main thing that we learned from Michael Mobussin. As I said, no investment committees. You can't have 4 people trying to take a decision. Take 3 people and take it.
Hmm. Interesting. Your journey has really been, every time I meet you, there's so much to learn. There's so many new things to learn. If you had to encapsulate your entire journey, 3-decade long journey of investing into a few key points, what would they be?
As I keep saying, no, first is investing is not arithmetic. Second is think where you are in the cycle. You will never be clear. But at some points, no, you will be clear. And when you're clear, you have to act with intensity. I would say that. And don't worry about the outcome. The moment you start worrying too much about outcome, you can't take decisions. You have to act and not think about the outcome. Every day you think about outcome, and that too here you're managing other people's money, it becomes very tough. So without thinking of outcome, you have to act most of the time. And that is what has worked over a period of time. And asset allocation works. At the level of the individual, asset allocation works. If you do asset allocation over a long period of time, most investors will be in a better shape over the next 10 years, 20 years, 30 years, 40 years. That is what I can clearly tell you. And this is something people kept telling me equity works, but I changed it with lot of effort. I tried to convince lot of people asset allocation works, and I would say it is much more comfortable from the point of view of the investor, that asset allocation is much more comfortable than depending on only one asset class. Take, for example, no one would have believed that gold and silver will be the best performing asset class in the last 3 years, 5 years as we speak. But asset allocation told you that you have to put some money there. And that is how multi-asset became such a interesting and important category.
Popular product. You think for someone who has maybe missed out on this multi-asset boom, you think 2026, 2027 multi-asset funds will continue to do well?
I don't know. Over the next decade, certainly. 26, 27 and all,
Okay,
I
yeah,
don't have
yeah.
answers.
So for someone like, in their 20s and looking to allocate money into mutual funds, multi-asset funds is still the best way to
No,
go?
but one of the best ways, considering that it has all the asset classes. It has equities, it has gold, silver, it has exchanged traded, it has REIT InvIT, it has debt, it has everything.
And taxation benefits also. Yeah. Because a lot of it gets done internally itself.
Yeah.
So you don't have that hassle, at least in multi-asset funds. Okay, this was a really special conversation. I enjoyed it a lot. Naren, thank you so much
Thank
for
you.
your time. I'm just going to wind up with a few, sort of ending notes, because our show is called The Money Mindset. So I believe that it's not so much about, tracking prices, valuations, fundamentals. That, of course, is the basis, is the fundamentals. But it's also about your mindset shift. Like, a lot of people have this scarcity mindset, and they, like you said, they just can't sell, or they just can't buy when markets are tough, etc. So what are the mindset changes that investors should remember to make when there is so much noise around you, when markets are down? Anything that you'd want to advise?
No, I think no, it's like, you have to focus on a process, and you have to first save. Then you have to ignore completely noise. How it is possible, don't ask me. But your goal is, as I said, I don't like the idea of too many full-time investors. I'm saying as long as you're not a full-time investor and you save money for a lifetime, it is too easy. Investing is too easy. Because I believe that over a period of time, what we think in ICICI is that you do hybrid asset allocation. That itself will take care. Then once in a decade, you'll get one opportunity. Something will go wrong somewhere in the world. When that something goes wrong somewhere in the world, at that point of time, I'm sure you will know that something has gone wrong seriously somewhere in the world. At that point of time, your money mindset should tell you that this is the time to take risks for the long term. That's all. So it's very simple actually. And every day you can't be bothered about what has happened to your money, what you're doing, what is happening to your money. The day you start worrying, has my NAV gone up so much this month, then that's a problem. Because if you are investing in the depth of the COVID problem, imagine looking at your NAV daily that day. It would be extremely painful. In 2008, people thought that the financial system is gone in the world. On that day, you invest. If you started looking at your NAV every day or looking at your net worth every day in the you would not have invested. So you have to have a proper detachment. You have to invest in periods of panic and not worry. In normal times, do asset allocation. Can you predict when panic will come? Who knows? Did we know that I joined this firm in 2004? Did I know panic will come in 2008 and 2020? And small panics at various points of time? Answer is no, we didn't know. But you'll have to do it. So that is a money mindset. So money mindset is a lot of detachment to the money. The detachment to the money allows you to make money. Too much attachment to the money does not allow you to make the money. This is my learning, which I share with a lot of people, and people say, "Are you sure?" I tell them yes, because it is. In fact, Howard Marks says that you can't, if you need to, you can't have this attachment. The day you have this attachment, you can't take decisions in panic. That is what Howard Marks says. He calls it something I'm not able to remember. But he says you can't have attachment. There has to be detachment. The detachment is what allows you to make money. It is the detachment to money which will allow you to invest in 2020, 2008, 2002. These kind of periods, it is only detachment which will allow you to invest. So the money mindset has to be a period. It will involve a certain amount of detachment and an ability to invest in panic. Can that be created? Most people can do it. Will everybody do it? No. If everybody did it, there won't be panic.
I think it's easier said than done, because if you look at our country's population of 1.4 billion people, there are barely 20, 30, 40 really successful stock market investors, right? If you count it, you can pretty much count it on your fingertips. So it's easier said than done, I guess.
Yeah, because to invest in panic is not an easy job. And that is why asset allocation is the second best. Asset allocation and SIP are clearly second best to investing in panic. So do asset allocation and SIP. That is also a good money mindset. Investing in panic is the best. Asset allocation and SIP is the second best. And don't start SIP in a asset
Euphoria.
class in Euphoria. That is not asset allocation anyway. So I'm saying asset allocation and not starting SIP in an asset class in Euphoria. That is what I would say is second best.
And any big regrets that you have in your investing journey?
No, I would say we are part of the lucky generation because I passed out of college in 1989. The regulator called SEBI got created, and they changed the entire capital market. I was telling people when I was an investment banker in early 90s. At that point of time, public issues used to take 70 days for listing. Now they take 3 days. So just look at how much the financial system has changed. And hats off to all the entities involved like SEBI, NSC, all the registrar, and the way digitization has happened, the way, we have managed to use technology in financial services. Hats off to everybody involved. So I think, our generation, my generation has been the luckiest generation because we got into the entire financial system at the right time.
You think success is all a lot about being in the right place at the right time and luck, or is there something more involved?
It is being at the right place at the right time. But in 98, 99, many people were in financial services between 1992 and 94. But in 1998, they left the industry for IT, for the technology industry. They all left. Whereas to stay in financial services between 98 and 2003 was the toughest part of my life, if you ask me,
Why was that?
because the industry was in very bad shape. Financial services industry was in very bad shape between 1998 and 2003. If you look at it, market did not deliver returns between 1994 and 2003. I think 9-year return in Nifty was zero between 1994 and 2003. So it was a very tough time. I had faith in equity markets. I had faith in the fact that India would finally deliver. So somehow I stayed close to equity despite equity not doing well. That was maybe contrarianism in
In its early stages.
in its early stages, I would say.
Okay. That's what taught you perhaps to be a contrarian
Yes,
investor.
maybe.
And it was really a pleasure speaking to you. Thank you so, so much for your time, your wisdom, and your energy. I mean, it's really infectious, all the advice, all the learnings. It helps everyone as individual investors and, of course, mutual fund investors as well. Thank you so much.
Thank you. Thank you. My pleasure. Happy New Year to everyone.
Yes, Merry
Thank you.
Christmas and Happy New Year. Thank you guys for watching.